It's the Real Estate Podcast, brought to you by ANZ Home Loans for financial well-beings.
Hey, welcome back to the Real Estate Breakfast in somewhat uncharted waters with this Iranian war escalation. Yes, no easy fix on the horizon here, and this is not going to be over anytime soon. And who is going to pay for this arm wrestle? Well, it's going to be people like you and me, isn't it? Consumers around the world. We are already seeing the Australian property market soften. This is the last thing that we need. And you would be deluding yourself to think that this war won't affect the housing property market even further, because the fundamental thing that you require, that you need when entering the property market, is confidence, more so than possibly any other time in modern history, except, of course, for the GFC. Is what we are starting to see right now the beginning of a 2.0 version of the GFC? Because nobody knows. Anyone giving definitive answers is guessing. How can you guess Trump's brain? It's impossible. Well, it is a Tuesday, July the 14th, and one of the countries that is struggling at the moment in terms of their economy is New Zealand. Let's take you to Wellington and catch up with Gareth Kiernan there. He is from Infometrics. And check out the New Zealand property market as well as the economy. Gareth, the Reserve Bank says the economy in New Zealand was recovering, but recent data is saying that the recovery lost momentum during the June quarter. Consumers still seem very cautious, probably even more so now that we're talking about the war. Construction, that remains soft and confidence hasn't fully returned. What needs to change then, do you think, before the New Zealand economy genuinely feels like it is growing again?
Yeah, look, we've struggled over the last 3 years, Craig, with high interest rates following that COVID period initially, obviously. Then it seems like every year from 2024 on, we seem to be hit by some sort of crisis. Electricity shortages in 24, Trump and his tariffs in 2025, and then the Middle East war this year. And so every year there's been something that's just really knocked the stuffing out of growth and set us back in terms of that recovery. We're hopeful, looking at things in late 25, early 2026, before the war came along, the worst signs the economy was actually looking in its sort of best health and the sort of green shoots of recovery. I hate that phrase, but it's what everyone talks about, that they were starting to come together before the war started. We're hopeful that if the oil starts to flow again through from the Middle East, the prices come down, that there is sort of a resumption of that improvement in business confidence. We have seen it. Consumer confidence is taking longer to sort of possibly pull back out of that, but we are hopeful that people start to feel a bit happier around their spending, about economic prospects, and you do start to see a broader economic recovery coming through. But like you say, it's hard to know exactly how that Middle East situation and indeed Trump's actions are going to pan out.
Yes, and the New Zealand house prices, they do remain extremely under pressure. Buyers have plenty of choice, as you say, and listings are sitting at some of the highest levels in years. Do you think that this is finally creating some genuine affordability, especially for first home buyers? Or are the buyers simply waiting because they're worried that prices could fall even further, which is, it's kind of that human behaviour. Oh, can we save some more money if they drop?
Yeah, look, it's very limited downward pressure on house prices that we have been seeing. They've been a little bit up, a little bit down over the last 2 to 3 years. So I don't think there's enough there from a buyer perspective to go, oh, I might lose 10% if I buy now because it's going to be 10% cheaper in 6 months' time. But on the other side of the equation, of course, there is no hurry if you're a potential first home buyer or looking at trading up your property to make that move, because it's not 2021 when if you didn't buy this week, it was going to be way more expensive next week as well. So yeah, that sort of softness that we're seeing in the housing market, you talk about how affordability has improved. We're looking at sort of house price to income ratios now, which are at their lowest since 2015, 2016. So that's pretty good, but still, less affordable than they have been at any time prior to that. So it's okay from a first home buyer perspective. I think what we've seen over the last few months is talk about interest rates starting to rise here has come through, and we've seen the Reserve Bank lift the official cash rate. Buyers have probably just been a little bit more cautious again, particularly when it was unclear about how far those interest rates were going to rise over the next 18 months with the sort of fuel price spike that we were seeing and worries about that feeding into more inflation. Looking forward from here, if the Reserve Bank isn't going to need to raise the official cash rate, up towards 4 or maybe 4.5%, and those rate rises are more moderate, then I would expect that buyers will start to have a bit more confidence that in 6 or 12 months' time, when interest rates have risen, they can still service that mortgage. So we might start to see a bit more demand coming through later this year or into 2027.
Last week, the Reserve Bank, they did move on the cash rate by 25 basis points. Was that kind of expected? Somewhat of a bit of a surprise, some people are saying.
Well, yeah, I didn't see it as surprising. I think when I had a look at the poll across analysts that we got from Reuters, that was showing about 80% of forecasters were expecting a rise, so not too surprising. And I'm still looking, I think, at the official cash rate, another couple of rate rises through to the end of this year, taking it up to around 3%. At the moment, there's general agreement that the cash rate is still stimulating the economy, which is appropriate, but when if we are looking at faster growth through 2027 and less spare capacity in the economy, then it is probably appropriate for the Reserve Bank to be lifting those rates back towards more neutral levels later this year and into 27.
Can I pick your brain, Gareth, with regard to this Iranian war? If boots are on the ground, the Americans decide to invade, the blockage continues. Already, you guys have got quite high petrol prices, the same in Australia. What is likely to happen? Like, you must have some kind of modelling that you do on these big bangs when they happen. I mean, this is absolutely unprecedented with what is happening there with the Iranian war. I mean, it could be very, very messy between now and the end of the year.
It could well be. I mean, at the moment, look, we did a set of forecasts in April where we did have petrol prices staying at elevated levels for a 6-month period and then not coming down particularly quickly. We have been surprised, I think, over the last month or so as, there's been signs of some sort of resolution, temporary though it might be, how quickly those oil prices have come back down. So our current forecasts are, things are looking a bit sunnier and the economy recovers. But certainly our April projections were more pessimistic, and it's just taking longer for recovery to get embedded because household incomes are being squeezed by those high fuel prices and it flowing through into higher prices for other goods and services, more than we possibly will see if petrol prices do continue to moderate from here. And, we've seen household incomes squeezed a whole lot over the last year anyway, or 2 or 3 years. You add in potential for higher interest rates, and it was difficult to get any sort of momentum in a recovery with those forecasts. As a forecaster, you have to draw your line in the sand and go, okay, these are our assumptions given the information we've got at the moment, then build it out from there in terms of how that plays through the economy.
We are talking to Gareth Kiernan. He is in Wellington. When we come back, has New Zealand become too dependent on the housing property market? That is next.
Don't forget to subscribe. We have so many episodes, all designed to help you better understand the constantly evolving and dynamically changing real estate property market. Listen to expert perspectives with exclusive real estate conversations and supercharge your knowledge base with us.
Yes, migration remains one of New Zealand's biggest economic challenges. Australia continues to attract large numbers of skilled New Zealand workers because of the higher wages. This brain drain in New Zealand is particularly affecting healthcare, engineering, construction, technology and also skilled trades. Australia remains the preferred destination for many skilled New Zealanders coming into the country, not just the Kiwis, of course, plenty of others. But if you are a Kiwi that has decided to move into Australia, we would love to hear from you. Our email address is myrealestatepodcast@gmail.com. You might be in New Zealand, you haven't left yet. Tell us the reason why you have decided to move to Australia. We would love to hear from you. It is a Real Estate Tuesday. Gareth is here. Yes, if New Zealand keeps losing these skilled workers to Australia, Gareth, does that become one of the biggest long-term risks to both the economy and the housing property market? What do you think?
It does become challenging, particularly for the property market in terms of that demand out there. And we talked earlier about the sort of stock of properties that is available for purchase at the moment being at 11-year highs. So, if you're not getting the sort of demand from people either coming into the country or you're losing sort of buyers or potential property owners out as they move across to Australia, it does mean that, there may well not be that sort of demand response or the sort of potential recovery in the housing market going forward, simply because there aren't the buyers there. There has been a bit of a stabilisation, a bit of a pickup in terms of some of those migration figures over the last sort of 9 to 12 months. Still not big migration inflows in net terms that we're seeing, but just a bit of a sign in terms of that outflow of people to Australia. Not quite as pronounced, the number of people leaving New Zealand and heading across the Tasman as it had been. Still much higher than we saw in the second half of last decade. And to put that in context for you, if you go back to the 2010s, second half of that decade, New Zealand's unemployment rate on average was about a percentage point lower than Australia's, and that was enough to keep our people here. At the moment, the figures are pretty much round the other way, where our unemployment rate is 5.3% and yours is sort of in the mid-4s.
Yeah, all interesting stuff that is going to play out between now and the end of the year. Has New Zealand then relied too heavily on the housing property market to generate wealth instead of investing in productive parts of the economy? Because New Zealand, like Australia, love the real estate market. People just swarm there. It is the honeypot, isn't it? But do you think that the country is finally maybe in this rebalancing stage, or are people still far too dependent on what happens in the property market?
Yeah, there's a couple of long-term sort of factors, almost generational things around the love affair of property in New Zealand. You have to go back to the 1987 share market crash when there was a whole bunch of people who had money in the stock market, and it was, a lot of that was wiped out. And so you had a whole suite of people who were like, I'm never touching shares again. Property is safe as houses. 20 years ago, we had the government establish the KiwiSaver scheme, superannuation retirement scheme, which is, some your contributions matched to some degree by the government. And that has grown to the point where I think around about 60% of the population are now in KiwiSaver, and people are becoming more open and more understanding of financial market investments. And so I think some of that love affair or that dependence on property to sort of drive your wealth and your retirement savings is not as great as it was before. You add in changes around tax policy from the government in terms of capital gains, which it's not that stringent sort of a test, but nevertheless, there's just uncertainty about that going forward in terms of we've got an election later this year. What might the Labour Party bring in if they do get elected into government in terms of just undermining some of the returns that you might be able to get from a property investment perspective as well. And so people, I think, are more open to investing elsewhere. And indeed, when you look at the returns on housing in New Zealand at the moment, from a rental perspective, your rental yields are not that great, and you can probably get better returns in the share market. My sense is that I think New Zealand's perspective is changing, whereas the Prime Minister has said, I'd actually like property prices rising, not too fast, sort of moderately, but I'd like them to rise because I think that's necessary for an economic recovery, for consumers to feel more confident and to feed into that sort of wealth story. So even at the political level, there is disagreement about whether we can have an economic recovery without the housing market being a part of that as well.
All right, good stuff there, Gareth. Yes, the incumbent governments, both in New Zealand and Australia, there's the doubters, there's the haters, and yes, the election coming up there later this year in New Zealand. It's going to be interesting to watch. All right, thanks so much for coming on to the Real Estate Breakfast this morning and giving us that update, Australia versus New Zealand's economy and the housing market. Enjoy your Tuesday.
Thanks very much, Craig.
We connect you to the best real estate information across Australia. The Real Estate Podcast.